Lower oil prices knocked energy stocks in Asia. Most regional equity markets fell on the day, with oil prices now down more than a fifth from their 4-year high seen in early October. Saudi Arabia has said that it's considering cutting oil output early next year. That's despite OPEC having revised demand for crude downwards going forward. Japanese stocks edged up. That's despite news that that country's economic growth contracted in the July to September quarter owing to weakness in China and a number of natural disasters that have hit that domestic economy. The Nikkei share average rose 0.2%. Hong Kong stocks were on a downer, and that's likely to have been affected by weak Chinese retail sales. The Hang Seng Index fell 0.6%. Chinese stocks ended weaker, partly on the back of weaker than expected retail sales in that country. The Shanghai Composite Index closed down 0.9%. Over in the United States, the Dow and S&P 500 ended slightly lower on Tuesday following losses in energy shares and Boeing, offsetting a small gain in technology shares and renewed hopes for progress in trade talks. The Dow Jones Industrial Average fell 0.4%, the S&P 500 lost 0.15%, and the Nasdaq Composite ended flat. And so for more on the markets, we cross to our correspondent, or our markets reporter, Arabile Gumede, who's standing by for us, not at the JSC, but at the Sandton Convention Centre. Arabile?
Yeah, good afternoon, Nompumelelo. Well, it's not even the Sandton Convention Centre. We're now at One Discovery Place, right? So Discovery has decided to launch, of course, the long-awaited Discovery Bank. It started off with medical aid and insurance. It went to this, the Discovery credit card, which, of course, worked hand in hand with FirstRand, but they decided to buy out FirstRand from that deal over a space of time and have decided to go into full-fledged banking. Just behind me, of course, is the room as well where the press conference is happening. It is the media launch of the Discovery Bank, and Adrian Gore, the CEO of Discovery, detailing and saying, of course, that the big banks currently are absolutely phenomenal banks. They work really well, but their integration and their interaction with consumers is perhaps one element that is lacking, and they believe they can target that and, of course, get a hold of that. Of course, let's remember they do have around 300,000 odd customers who are currently on the Discovery credit card, and they'll certainly gain those customers already to enter into the banking sector, so perhaps a firm footing. Let's unpack that and also just how the markets are faring as well. I'm joined by Michael Traherne, Portfolio Manager at Vestec. Michael, thank you so much for joining us out at One Discovery Place, a really great and massive building though. But this must be a big change for South Africa's banking sector. Do you think they'll be able to perhaps change things up a bit?
Yeah, I mean, for the consumer, this is great. Choice for a consumer is always good. You want to see competition. You want to see the big four banks, or big five now, if you include Capitec, competing on fees, bringing down costs. Part of Discovery's metrics, they show that if your vitality status is gold or silver or even the diamond, you're better handling with money. So imagine applying for your home loan and they're asking what's your vitality status. So it's exciting space to be in. Change is good.
Yeah. At the same time, it brings a lot of competition within the sector. And do you think that this is the right time for banks to perhaps be looking over their shoulder? I mean, there's so much competition, of course, coming through. How does that help customers as well in the long run with regards to fees and the like?
Yes, competition is definitely bringing down fees. It also make the banks' reward programs more competitive. And it depends how the banks are going to target customers. In the case of Discovery, they've already got a large amount of customers in your higher LSMs, and those are the people they're going to target first. They're going to go, guys, you're on diamond status, you already have the card, you already have life insurance. Why not move your banking to us as well? We'll give you a package, we'll bring down your fees, and we'll do a branchless thing so you can contact what you would assume is their highly skilled staff. You won't have to walk into a branch, something similar to what the Investec model is currently. I think if you Investec and you FNB, you may be slightly nervous because I think those are the customers that are going to be targeted first based on this type of offering.
Yeah. Technology is going to play a critical part in that. But Michael, let's turn our attention a little bit to the overall markets. The JSE All Shares, well, down around 1/3%, but it could have been worse. It was a little bit worse before around midday today.
Yeah, it was down about 1.5% coming into the morning. It was really tough, but just after 12, Tencent released their numbers. Third quarter growing profits by 30%, revenues growing 24%, so a beat on what analysts estimates. Naspers goes from being down 1% to being up over 3%, and you can probably expect that momentum to carry through for at least the rest of the week, in my opinion. Yeah, just the concern around Tencent was how is their gaming division going to do, given that Chinese authorities have slowed down the approval of games in China. And the numbers do show that the gaming division was under pressure. But Tencent diversified away from gaming, away from WeChat, and they've got a lot of investments in smaller companies. And a number of those have now listed on the New York Stock Exchange, and that's where these profits are coming through, is through the other investments, and it shows you the value of being diversified.
And as you said, they did this despite the regulatory issues that they've currently obviously seen. What happens to the tech stocks, though, overall? Yes, we've got the one now that is certainly going to, do a little bit well for a couple of days, maybe. But it seems to be a complete tumble around the world. That is, from the United States right through to Asia, and even here, that seems to be a massive hole, and that's where we used to get all our growth from.
Yeah, so this year seems to be, in terms of stocks, a year of overreactions. I would say that tech stocks sell-off's probably been a bit too harsh, opinion of course, but Tencent doing better than expected. That'll give some momentum to the tech stocks until the next piece of news comes out. A particular concern to the markets at the moment is what happens with the Brexit deal, what happens with Italy's budget. Those are two very Eurocentric things. And then what happens with at the end of the month with the G20 meeting. Do Trump and Xi sit down, have a meeting, say, okay, let's put this behind us? And if that is the case, you're going to see tech stocks doing really well. These companies are sitting on hundreds of billions of dollars in cash, looking for a place to deploy it. The current trade tensions slows down where they can employ that money. And if those trade tensions are removed, then growth essentially returns to these tech stocks, and you should see quite a big boom going into the end of the year. Yeah. Fingers crossed.
We hope, as you said. Saudi Arabia, the oil story, that just seems to be going in one way and another. Donald Trump says one thing, they head in Donald Trump's direction and almost forget what Saudi Arabia says, now firmly below $70 a barrel, even around $66 a barrel. That's a good mark for us, but the oil exporting nations must be certainly kicking themselves here.
Yeah, it's always tough. I mean, if you look on the home soil, Sasol, whose head office is down the road here, and that share price, I think, was down 4% earlier today, and that's because the oil price keeps dropping. 2 months ago, all the forecasts were for oil to be over $100 a barrel. Now forecasts are coming back down to say, maybe you'll be back at $50 a barrel. It's a case of oversupply in the market. US supply is coming online a bit quicker. Where the big thing was Iranian sanctions were expected to nullify Iranian oil exports. It seems that the American administration has granted a lot of waivers. India, China being two big nations that are able to now still buy Iranian oil. So effectively, Iran, which was forecast to be out of the market, is still in the market, and that extra, I think they got 1.5 million barrels a day. That's putting pressure on the supply and demand metrics.
Very finally, local stories, retail sales going up only 0.7%. It's a dire picture for South African consumers, isn't it?
Yeah, it's tough. It just shows you how tough things are, particularly going into the festive season. You've got Black Friday next weekend, so let's hope that consumers don't overextend themselves. But still, 0.7% not great. But if you consider that we're currently technically in a recession, 0.7% you can't complain about. I mean, our growth forecast for 2018 is only expected to be around 0.7, 0.8. So it is in line, but we need a lot more growth if we're going to get unemployment down. You need growth of 3, 4, 5%. Preferably 5%.
Michael Trone, appreciate your time there, portfolio manager at Vestact Asset Management. With that, let's just take a quick look at how the local and European markets are trading.